Welcome everyone, and today I am going over the breaker block. This is not a model, it is an entry to the model. The breaker block is predominantly used in my AM reversal model, as well as my data model for high impact news days. And it is rare that it will ever happen for the AM continuation model. Nevertheless, I'm going to teach you guys this entry method because it is another way for you guys to take advantage of when the market shows you an opportunity. So without wasting any more time, let's get straight into it. So the breaker block, what is it? Some of you may already know what it is, but I'm going to help those further understand, or those that don't know what it is, to teach them from the ground up how to utilize this entry method. The entry mechanism is composed of, number one, a swing high, followed by a swing low, followed by a higher high. Now let's not confuse it here. Swing high, swing low, higher high. Then price breaks that initial low, forming a lower low, and then retests that initial low before dumping. Vice versa for longs. So for shorts, you get a high, low, higher high, lower low, retest the initial low, and that's your entry. Note, like I said, this is only the entry. It must be paired with the model revolving around it, which means it must sweep liquidity in the process, must reverse, must break structure, all in the process, which a break of structure will, of course, happen in this case. So let's move on. So let's analyze the breaker block. So you can see where the orange arrow is, price formed a swing low. This is for longs now. I'm showing you the other way around. Price formed a swing low. The purple arrow, price formed a swing high. And then it formed a lower low at the blue arrow. So you got a low, a high, and a lower low. Once it swept liquidity, price formed a higher high, breaking through that initial high. Then it retests that initial swing high, and that is our entry, targeting opposing liquidity and imbalances. I hope we're still keeping up here. We're going to show as well images from the charts itself for you to get a good grasp of what this looks like. But this is the rough sketch and concept of that entry method. So let's get into one example of that breaker entry. This is looking like what we have shown you as the AM reversal model. It sweeps sell side liquidity, rejects a bullish fair value gap on the 15-minute time frame, adding confluence to engineer a run higher. So you will go to the lower time frame and look for that entry. This is the exact same chart as shown on the last slide, just on the lower time frame. And I'm showing you a side by side with the arrows, showing you exactly what is what here. You get on the orange arrow, swing low, purple arrow, a high, blue arrow, lower low. It reverses after sweeping liquidity, rejecting that higher time frame bullish fair value gap, breaks through the initial high, retests that initial high, and that is your entry, targeting higher opposing liquidity and imbalances. One thing you must note, what exactly is the breaker block? How do you know where to put the box? If you're going long, like in this case, that initial high, the purple arrow, you take the highest green candle, highest up close candle, and go from the high to the low of that whole candle and form the box as the breaker. Now for shorts, you do the opposite. That initial swing low it makes before making the higher high and breaking through the initial swing low, that initial swing low it makes, you look for the down close candle that is leading that swing low, that initial swing low, and you form the box around it from the wick's top to the wick's bottom. That is the breaker block. As you can see here, the purple arrow, this swing high, before we made a lower low, the initial swing high, we found the highest up close candle, went from the top to the bottom and formed that breaker block. That is your entry. So let's continue. Without the arrows now, just looking at the chart, I want you guys to be able to see it without needing any arrows or guidance. You see, price come down, form a swing low, form a swing high, form a lower low while sweeping liquidity and rejecting a 15-minute fair value gap. Once it does this, it reverses, breaks through that initial high, and the breaker block is now set up. You wait for the retest of that breaker as your entry, and then you target opposing liquidity. Now, stop loss placement. Ideally, you would like to put your stop loss below the swing low, the lowest low. If the risk is too high, and only if the risk is too high, and you are convicted in your setup, and the bias as well as your model all are in accordance, you can put your stop loss just below the initial swing low. Not the second one that makes a lower low, the initial swing low. And if you were to go short in this situation, you'd put it above the initial swing high, not the higher high, the initial swing high. Now, you run the risk of it being hit more frequently. But I told you, if the bias meets and is in accordance with the model, you can do that if the risk is too much. Now, if the risk is suitable, you will always put it at the higher high or the lower low. The lowest low when you're going long, the highest high when you're going short. So let's look at how this trade played out. You got the lower low, higher high, lower low, sweep liquidity, reject the 50-minute fair value gap, reverse, break through that initial high, and retest that initial high as the breaker. You enter there, set the stop below the low, and target the opposing buy side liquidity. As you can see, I left the time in the chart as well. This is around 9:30 to 9:40 a.m., which is in the time frame of that AM reversal model. So everything is lined up. You enter, and as you can see, price forms a leg up, retests, comes back down to retest the breaker, forms a leg up, comes back down one more time to retest the bullish breaker, and on every single attempt, it failed to break through that breaker and went up to buy side liquidity. You can see that price retested it 1, 2, 3, 4, 5, 6, 7, 8 candles throughout this trade. Tested this breaker block. And every single time, it ended up going where you wanted it to go. To add on to this, you can see I added a take profit level. I'm someone that is for partials. I think if there is an area where you can expect a retracement, you should take profit, scale out a bit. As you can see on the lower time frame, that opposing liquidity, that green line across the chart, that is opposing liquidity. That is a solid place to take profits. You can see that on the first leg up, price went right to the take profit level before making a full retracement and then going back. Now, there will be instances, it's possible that it goes to that take profit 1 level and completely retraces. Well, in that case, you would have taken some partials. So, in areas where you can expect a reversal, you can expect liquidity there. It's never a bad place to take profits. Now, I'm not saying take profit at every single potential liquidity area. No. Significant ones. You can see this is a significant high. And so that is suitable for us to take profit. Now it comes down and retested the breaker several times before going to buy side liquidity. So this is a brief description on what the breaker block is. To recap one more time, price comes down, forms a low, a high, a lower low, sweeping liquidity, rejecting the higher time frame for value gap. Reverses, breaks through that initial high. You form the breaker from the up close candle's full range. Retest it, and that is your entry. Ideally, stop below the low, target opposing liquidity, and you can take partials at internal liquidity as well. And just like that, that is how you utilize the breaker block paired up with the AM reversal model and several other models. I hope this video was insightful. And like always, good luck and good trading.